Hi, welcome. My name is Ulf Holmberg, and I want to talk to you about the Global Consciousness Project, its data and sentiment, because I want to explore this link together with you and demonstrate that it can be used in practice. So let's begin by defining sentiment. Now, sentiment is defined as a general feeling, attitude, or opinion about something. It's also defined as gentle emotions such as love, sympathy, or caring. And the third definition is that it is defined as people's opinions or feelings about a situation, especially the likely future direction of financial markets, the economy, etc. This final definition is the one I want to explore in this talk together with you. But it's not really clear why the Global Consciousness Project's data should react to sentiment. Previous research has shown that it tends to react to coherent attention when we simultaneously together focus on an event of interest. That is what gets picked by the Global Consciousness Project's data. That's not the same thing as sentiment, unless that event affects the way we view the world and how we interpret the world around us. There's one such example I find very interesting to study in this case, and that is what happened in 2020, the global pandemic. So let me bring you back to 2020. On the 25th of February, some headlines reported here. In the US, there was reports of the coronavirus and death tolls and so forth, and also what happened outside of China as the outbreak was spreading in Italy and in Europe. The Guardian in the UK reported on that Europe was on alert as 4 more COVID-19 deaths was reported in Italy. And also Switzerland, Austria, Croatia reported first cases as outbreak worsened across Europe. And in China, also China reported about COVID-19, but how it dropped. So one can have an idea here that it had broken out in China, as we all know. It had moved over the world. Now it was affecting Europe. So let's look at how the Global Consciousness Project's data reacted on this date when these headlines were made public. Now, here is a metric of the deviation from chance derived second by second from the Global Consciousness aggregate data. And I've circled on this area between 5 a.m. and 6 a.m. in the morning. This is UTC time. Now, when you translate that to European Central Time, that translates into something around between 6 and 7 in the morning. Precisely when most people tend to consume the morning news in some form or another. Now, you can see this as a very large deviation from chance, and if you would plot in another metric, which is the 50-minute bursts of these deviation from chance events, you can see that it spiked to the biggest value there. And if you take that one out and call it the max Z variable, you get a value of 3.5. And you can do this for all dates stretching back to 1999. Then you have a daily measure of the GCP data effect. That is the one I've used in my research and the one I want to explore together with you today. Now, the max Z variable, what is it and what does it do? So if you would look at how it should look theoretically, you can simulate it. And that's this solid line here. That's the distributional plot. of the max Z variable, how it should look like. But if I extract it from the GCP data on a daily basis, I get something like the dashed line. And as you can see, it shifts the distribution to the right. So you could expect that if something happens, the max Z variable will be shifted slightly to the right compared what should have been expected if it was pure by chance. Now, the GCP data metric max Z has been shown to correlate with daily stock market returns in previous research. In 2020, a study showed, published in the Journal of Consciousness Studies, showed that it correlated with several indexes all around the world, from Asia to Europe to the US. The year after, in 2021, it was followed up with another publication in a different journal showing that the results were solid. In these papers, one could see that it behaved a bit like sentiment, because there was a slight predating element to it. That's not so unusual when it comes to sentiment, at least not when it comes to the full effect of sentiment changes, because if something happens that affects our perception of the world, sure, we'll trade on it during the day, but you will also trade on it the next day, because if that feeling stays with us, it will affect our behavior also the next day. But given these similarities with sentiment, it seems like the GCP data could be used for understanding market sentiment more deeply. That's what we want to explore now. Here we have two time series. To the left, you have changes in the VIX. VIX is a common market sentiment measure, so it reacts strongly to events affecting financial markets or affecting the world. So if you look back in time here, you would see it was very reactive back in 2008, 2009, that is during the financial crisis, but also during the COVID-19 pandemic. To the right is a much noisier series. It's the max Z variable. That is the maximum daily 50-minute bursts, as I showed you previously. Now, if we look at these two time series, you would say they are not related. It's all just only noise. But is it? It's studied by taking into account that the changes in the VIX has a clear autocorrelation to it. And if we control for that one, will you still find something that actually relates to the max Z variable? Well, we could do some econometrics on it by taking linear models and studying it by introducing interaction terms. Now, the interaction terms I want you to focus on here are the significant ones here. That's bold-faced. And here, so you can see that it's very, very significant. There's a lot of stars on it. In fact, it's significant at the 1% level, making it very unlikely to be due to chance. So in fact, it seems like the max Z variable interacts with market sentiment if something happens today, if something happened yesterday, the day before, or even 3 days in the lag. So there's something here. In effect, it actually increases the amount of explained variance because the R square increases. So what you can take from this table is that market sentiment interacts with the max Z variable in a very significant way. Then one can think about, since market sentiment can be utilized by, for instance, traders, maybe the max Z variable could be utilized by traders. So I designed two different day trading models, one with max Z variable and one without. Well, when one does that, one has to think about that markets affect each other. So markets in Asia will affect markets in Europe, which will affect markets in the US or the Americas, and then which then will affect markets in Asia, and it goes round and round. So the question is then, when one tries to study market sentiment, shouldn't one want to control for all of this? Well, of course. But you can't still control for all these markets because that will be a lot of variation to take into account. But you can study some specific versions, or versions, but specific markets. First, you can focus on the one in Japan, the Nikkei. Then you can think about the one in Hong Kong, the one in Sweden, Stockholm, the OMX, and then how all these markets affect the New York Stock Exchange. And that is what I've done. But I also control for market sentiment. And I asked the question, can this max Z variable be used to improve daily trading models? And then, as I said, I estimated two models on the S&P 500 index, those returns. One used the GCP data and one ignored the GCP data. I used that as the control model. In all other senses, it's exactly the same model, but the exact same variables, but the GCP data model also includes covariation terms with max Z. Then I test the results by saying, okay, so on the 1st of August 2022, I'm going to estimate the models, which I did. And then I started I had a sample simulation that lasted for a predefined period of 1 year. So on the 1st of August 2023, those simulations ended. And then I can compare the simulated outcomes. Because it's the relative difference between them that is the important thing here. If the GCP data actually picked something up that can be utilized, then the returns that you simulate out of it should be larger. So let's have a look. In this figure, I've depicted the GCP data, its fund and its relative performance compared with the control model. As can be seen, it is positive. So the solid green line is for trades made using the open price. So when the open market opened in New York, you can use those prices in order to look into what the total return would have been. And then compare that with the control model traded exactly the same way. Now that's not really fair, because if you would think about when the market in Stockholm closes, it closes at UTC 1600 hours, which is around 11 a.m. in New York. But you can control for that and make trades using this version of the model as well. And that would be the dotted line. But also this one has a relative return that is positive and higher. So the GCP data fund that you derived using the GCP data model resulted in higher returns than the control model. Now, in numbers, I think this is slightly even more interesting. Because here you can see that the unfiltered version, I'm going to discuss what that means shortly, the GCP data fund produced returns that were around 11% higher than the control fund. And if you filtered it, that is, you ignored very small values of max Z, values that were very likely to be due to chance, then those returns were increased up to around 14%. Now, if you waited with making the trade to around 10 a.m. in New York, that is UTC 1500 hours, those returns were slightly smaller, but still positive. And even if you waited until UTC 1600 hours, that is when the market in Stockholm closed, they were positive. Well, one could, I suppose, argue that these returns are due to chance because only one or two major trades could have resulted in that the total return to the end of the summation period was higher. So let's look at the relative hit rate. The relative hit rate is the share of returns, the result positive returns on the GCP data fund minus the share of positive returns in the control fund. So you can see that it's positive here as well, suggesting that if you would use a GCP data fund instead of the control fund, between 0.5 and 2.5 percentage points of all returns would have been positive more than with the control fund. There's only one negative number here, and that is if the trades were made at the UTC 600 hours. That's the unfiltered version of the GCP data fund produced a negative relative hit rate. However, as soon as one ignored these very small matches at variables that were very likely to be only due to chance, that one turned positive as well. So here are results that point very strongly towards the usability of the GCP data. Now, let's make sense of the results. Think of this as some unknown statistical quantity that produces the GCP data effect. These slight deviations from chance that can be picked up into the data. Now we know from previous research that coherent attention tends to produce this type of deviation from chance. So let's just put that one in there, the Venn diagram like this. And now we know that market sentiment also relates to the GCP data. And coherent attention is a very likely mechanism resulting in the change in sentiment, but not always. And then there is this intersection with stock market returns. So this is how I view it and why global stock market returns are affected or co-vary with GCP data. So let's sum up. I first argued that the GCP data should relate to market sentiment because coherent attention on engaging events could change our perception of the world or the sentiment we have. I tested for it by using econometrics and allowing the maxZ variable to interact with VIX, which is a common market sentiment measure. I then argue that if that effect is real, it could be utilized by traders, because if you understand how sentiment moves, you could noise trade on it. So I designed two separate day trading models, one that acknowledged GCP data and one that totally ignored it. And then I onset simulation. Using these models, I simulated returns for one full year, and then I compared the outcome of one fund traded with GCP data and one with that. And these results were very, very in favor of the GCP data being able to improve daily returns. So the implications of this study is that GCP data can be used in practice by forecasters in general and by traders. Thank you for listening.